Money FM 89.3. Best of breakfast. The bigger picture, only on Money FM 89.3.
Good morning. Welcome to the bigger picture of me, Ryan Huang. And we've got lots to talk about today, including what's happening with Donald Trump and his plans to slap tariffs on the rest of his European counterparts. You have also a recession indicator flashing a danger sign. We are talking about earnings from Nvidia, as well as back home, the latest tussle with what's going on with city developments. And helping us out this morning, we've got Abhilash Narayan. He is an investment strategist at HSBC Global Private Banking and Wealth. Abhilash, good morning. How is your morning going so far?
Good morning, Ryan.
All right, it's turning out to be quite a busy one. So let's start with what's happening on the global front with Donald Trump vowing to slap 25% tariffs on the EU. And he has a lot of choice words for his friends or allies. What do you make of his latest move right now, and how is the market digesting it?
Well, I would probably look at it as one of the parts of the roller coaster ride on tariffs we have seen under President Trump, right? If you think about it, on campaign trail, he had promised 60% tariffs on China on day one, but ultimately imposed only 10% tariffs on China, leaving room for negotiation. And a similar thing happened with Mexico and Canada. Everyone was expecting a 25% tariff, and then at the last minute, President Trump announced a month's delay. So, as far as Europe is concerned, another sort of 20-25% tariffs is certainly possible, but we should be bearing in mind that things can change at the last minute. When we're talking about the tariffs in Europe, I think very interesting thing is that actually US imposes a higher tariff on imports from UK and France than vice versa. So if Donald Trump actually undergoes the reciprocal tariffs, then US should actually be lowering tariffs on Europe. But I think all these facts can get lost in the big social media headlines. So we think tariffs will be an overhang for Europe in the near term. So despite the recent rally, we are underweight on European stocks.
Okay, so also in the mix is what's happening for Nvidia, because earnings were out and it is one of the most watched companies these days. What is the impact of it beating expectations? What is going to be ripple effects for example, Asian chip makers? What's priced in already? What are you expecting? What are your takeaways here?
Yeah, clearly it was a very, very important data point for the markets, especially, given the concerns around demand for high-end chips after release of DeepSeek's R1 model. Now, based on the market reaction, I would say the results are somewhat mixed. The company forecasted higher revenue going forward, but slightly lower margins than analyst forecasts. But I think beyond, the outlook for individual company or chip makers, we think that, the artificial intelligence-led investment wave is here to stay as a key theme. But we think that the next leg of AI wave will actually benefit software providers who integrate artificial intelligence models to deliver, real-world benefits to the users. So we can actually talk about whether, the demand for chips will be higher or lower. But what is clear is that lower cost AI will actually benefit other sectors to adopt them faster. So, while tech sector remains in solid shape, driven by, tailwinds from AI and cloud computing, we actually think that the rally will broaden out in the US. So we continue to like healthcare, industrials, financials, and communication services in US, apart from technology sector.
All right, let's bring it back home, Abhilash, where we have city developments in the headlights or in the spotlight because of a tussle between father and son. You have the executive chairman, Kwek Leng Beng, publicly criticizing his son, Sherman, who is the group CEO, and he is accusing him of attempting a coup. What do you take away from what's playing out for CDL as well as what is the broader impact for Singapore markets?
Yeah, it was certainly an unexpected development. And, looking at the media reports, there have been sort of concerns around corporate governance, which have been mentioned. And let us remember, this comes on the heels of controversy around Singapore. So, when I look at the implications for the broader market, it is a mild negative. And, let's not forget that in the latest budget, the government announced that it wants to boost the attractiveness of Singapore stock market. Last week, we got, measures which were announced, including investment by MAS and tax incentive for fund managers investing sizable portion of their portfolio in Singapore equities. And a renewal of concerns around corporate governance do dent the government's effort to attract foreign investors and make Singapore a more vibrant market. So it's a minor setback, but when we look at fundamentals, we still think they are quite solid for Singapore, and we maintain an overweight stance on Singapore equities for the next 3 to 6 months.
Yeah, let's talk about that overweight view you've got on Singapore stocks. And you mentioned fundamentals, and of course, banks in recent weeks have been reporting some stellar numbers. Walk us through some of these, I suppose, catalysts for the Singapore market to go up further.
Yeah, I mean, you mentioned banks, right? And banks are a very, very important sector for Singapore equities, given that they account for almost half of the index. Now, we are neutral on the banks because while they clearly have reported very, very stellar earnings, we think that a lot of the good news is in price. Now, looking ahead, they face a mixed outlook. They may face modest margin pressures due to lower interest rates, but clearly their focus on wealth management is leading to good sort of earnings expansion. But, when we talk about Singapore equities in general, despite the broader rally we have seen over the past, 6 to 12 months, Singapore equities still remain quite attractive. I mean, the PE ratio right now is below the 5-year average. And when you combine that with the attractive dividend yield that Singapore offers, we think increasingly going forward, it will become a more attractive play for income-seeking investors. So, banks are neutral on. The sector that we like within Singapore is REITs. So we think that, lower interest rates going forward should lead to, a positive outcome for REITs, given that they are inversely correlated. And we do see some pockets of opportunities there.
All right. In the universe of REITs, is there a particular subsector? You've got commercial, retail, office space. Is there one that stands out for you?
Well, clearly, the retail REITs will benefit from some of the, consumption-boosting measures, the vouchers that have been announced in the latest budget. And logistics sector continues to be quite strong. But I think our preference, rather than going for any particular sector, would be on REITs which have solid balance sheets and low gearing.
All right, REITs to watch as we see Singapore markets to potentially go up further. We've been in conversation with Abhilash Narayan. He is an investment strategist at HSBC Global Private Banking and Wealth. Abhilash, thanks for your time this morning and great chatting with you.
Thank you.
All right, catch up again soon. Stay on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.